Okay, I wanted to go ahead and go through one more brief illustration of the cost method versus the equity method. This is really one of those topics where at first it seems kind of intimidating, but once you have that aha moment, it's very simple. So we have a very simple example here. Big purchases 80% of the voting stock of Little Company for $800. The non-controlling interest on that data is worth $200. Little's book value is $900, so there's a $100 differential. And let's assume that's all due to undervalued property, plant, and equipment with a 4-year life. So $100 over 4 years will be $25 per year amortization. Let's assume that Little reports earnings of $100 per year and Little pays dividends of $20 per year. Now let's go ahead and do the equity method and the cost method sort of in parallel and see how they differ. So first under the equity method, and let's go ahead and skip the initial acquisition. Let's just focus on the ongoing entries. Under the equity method, we're going to have income, dividends, and amortization. So, okay, for some reason, my font is all messed up there. Let me go ahead and clean this up a little bit. There we go. Okay, so Little reports earnings of $100. Big is an 80% shareholder, so they get 80% of that 100. Dividends, Little pays $20 in dividends. Big gets 80% of that. And then amortization, again, $25 per year amortization. Big's share is 80% of that, or $20. So that's going to reduce our investment income. By our share of that $25. Okay, and let's just go ahead and sort of summarize where we are right now. Our investment in Little account had an initial balance of $800. We added the $80 from our investment income. We subtracted the $16 from our receipt of dividends, and we subtracted the $20 from the amortization. So I need a plus sign in front of that. So the investment in Little is $844, and the investment income, they had $80 of income minus $20 their share of the amortization. Okay, under the cost method, basically all they're going to have is they're going to receive $16 in cash, and that's going to be their investment income. So same thing, their investment in Little is stuck at $800, the cost of their investment, and their investment income is 16. Okay, let's go ahead and do our elimination entries. Okay, so first we do our S entry. We eliminate the subsidiaries beginning of your equity accounts. Now, I didn't specify what their equity balances were comprised of. It simply said book value $900. And so I'm simply going to write Little equity 900. We record the differential. And again, that $1,000, the book value plus the unamortized differential, is going to get split 80-20 between the parent's investment and the non-controlling interest. A for amortization, same as always. I for investment income, we've already determined that that's going to be that $60 up there. D for dividends, we have to eliminate the subsidiaries' dividends declared, which were 20. And again, that would be split 80-20 between the parent's investment in Little and the non-controlling interest. Lastly, we have the income to the non-controlling interest. They're going to get their share of the subsidiary's adjusted earnings. And again, the reported earnings were 100. The adjustment was 25, so the adjusted earnings are 100 minus 25, or 75. And the non-controlling shareholders get their 20% of that $75. Okay, so again, this is the same thing we've done over and over again for a while now. Under the cost method, in the first year of ownership, there's only going to be really one change that we have to make. S entry, same as it was before. We eliminate the subsidiary's beginning of year equity and the unamortized differential. We create the unamortized differential asset. That total of $1,000 gets split 80-20. We do our A for amortization. We do our now. The one difference in the year of acquisition is going to be that the I and the D entries, the investment income and the dividend entry, are going to be combined. Now, in fact, you could, mechanically you could. I would strongly recommend not doing it because it's better to sort of understand the process of what you're doing rather than simply memorizing a mechanical process. You could do this. Basically, you could eliminate the investment income of 16 and credit the investment a little. Now, after this entry here, you have now zeroed out the investment in little. That's one of the goals of our consolidation process. We want to get rid of the investment in little. And we've done that with that first S entry. By doing this, we're eliminating the investment income, which we want to do. Again, the investment income is $16. We eliminate the investment income, but we're crediting the investment in little for 16. We're reestablishing now a credit balance in the investment in little, which we then proceed to eliminate again, in the D entry. It seems much more reasonable to simply combine the I entry and the D entry, eliminating the dividends declared and eliminating that against the investment income and the non-controlling interest. The income of the non-controlling interest is exactly the same as it was before. So again, this was, year one. I'm going to go ahead and merge and center and put that in big, bold font. What happens in year two? This is where another change is going to take place from our between the cost method and the equity method. So again, let's go ahead first and just copy this stuff and make changes as appropriate. Okay, so equity method entries. Same as before, we record our share of the investment income, we record our share of the dividends, we record our share of the amortization. Our investment in little now, last year was $844. We just added $80, took away 16, took away 20, so the investment in little is now $888. The investment income is again $60, just like it was last year. We do our elimination entries. Little's equity is now up to $980. Again, last year was $900. We would add Little's reported earnings. We would subtract Little's reported dividends. So Little's equity is up to $980. Property, plant, equipment net has been amortized partially. That's now down to $75. So the total on the debit side of this entry, again, this is the beginning of your book value plus the remaining unamortized discount. The total is $1,055, and that $1,055 total is going to be split 80-20 between the investment in little and the non-controlling interest. So the investment in little is going to be 80% of that $1,055, or $844. The non-controlling interest is going to be 20% of that $1,055, or $211. Now, a couple things to notice here. This 844 for the investment in little, that is the beginning of year 2 investment balance. Let me go ahead and put these in bold font to better visually set them apart. This 844 for the investment in little, that's the beginning of year 2 balance. That is the same as the end of year 1 balance. That's by design. That's how things roll forward from one year to the next. The end of year 1 investment becomes the beginning of year 2 investment. Same thing with the non-controlling interest. This 211 for the non-controlling interest, that is the sum of the 200 we created last year minus the $4 we took away, that would be $196, plus the $15 we added, $211 total. That's where we're starting at in the following year. We do our depreciation expense again, another year's worth of amortization, another I for investment income entry, another D for dividends entry, another income to the non-controlling interest entry. That's all the same as it was before. Under the cost method, again, we do our dividend receipt of $16. That's our investment income. At the end of the year, our investment in little is still stuck at $800. That investment in little is going to stay stuck at $800 forever, unless there's some permanent and significant impairment where we have to write it down. Investment income, $16 again. So when we do our elimination entries, as before, the little's equity is now going to be $980. That part doesn't change. How big chooses to account for their investment doesn't have any bearing on how little accounts for their activities. Little still has owner's equity of $980 at the end of year 1, the beginning of year 2. Property, plant, equipment net is again down to $75. What's different now? So again, this is the same total on the debit side, $1,055 total. Now, ideally, let me make a little bit of room here. Ideally, we would take that $1,055 and split it 80-20 between the investment in little and the non-controlling interest. Now, however, the investment in little is stuck at $800. That means that while we'd like to allocate $844 total to big, let's think of that as the total allocation to big, $800 of that is their investment balance. The other $44 is going to be an adjustment to big's retained earnings. Basically, and the non-controlling interest, 211 again. Basically, this retained earnings figure is nothing more and nothing less than a plug figure. If you really want, we're sort of coming to a fork in the intellectual road here. Let's go and round this out first. So we continue doing our elimination entries. We do our A for amortization, our combined I and D entry, and the income to the non-controlling interest again. Now, a couple things I want to point out. The only things that have changed here has been how the investment in little is being dealt with. The non-controlling interest is the same in both cases. In year 1 it was 200, in year 2 it was 211. How the parent chooses to account for their investment on their books has no bearing whatsoever on the non-controlling interest. Likewise with the income to the non-controlling interest, whether we use the equity method or the cost method, the income to the non-controlling interest is exactly the same. Now, on the one hand, you could say, well, I've got faith, whatever this difference is between the parent's investment balance and their 80% of that debit total, whatever that difference is, I'm just going to go on faith and say that's an adjustment to retained earnings. Where does that come from? That comes from the cumulative difference between what Big has reported as investment income in the preceding years versus what they would have reported had they used the proper equity method. Again, a keyword there was preceding. Prior to year 2, under the equity method, Big would have had investment income of 60. That is the correct value. They should use the equity method. Because they choose to use the easier cost method, they only reported investment income of $60. So in a sense, they understated their income by $44. Again, it should have been 60 using it if they had done the proper accounting. Instead, they took a shortcut and only reported 16. They understated their income by 44. That means that in year one, big company understated their investment income, which means they understated their retained earnings. And what we're doing here is we're fixing their retained earnings, adding that missing $44. So again, the only difference between the cost method and the equity method is first, the business of the combined income and dividend entry versus the separate investment income as one entry and dividends declared as a second entry. So that's one distinction. We're combining those two entries into one. I'm going to go ahead and get carried away here. Insert some shapes, draw some lines. We'll draw a line there, and we'll draw a line there. Okay, so we combined those two entries into one entry. The second difference is in the S entry. When we carry forward the information from the previous year, there's always going to be, again, after the initial year. In the initial year, there's no difference here. After the initial year, there's always going to be this adjustment to retained earnings, which serves as a plug figure to reconcile the parent's investment balance, which is their cost or their original value, as the Christensen text calls it, and their share of the subsidiaries' beginning of year book value plus remaining unamortized differential. Okay, I hope that helped. Certainly couldn't hurt, hopefully.